The history of money has always been, at its core, the history of power. When emergent technologies threaten to rewrite the fundamental rules of the game, states begin to genuinely worry. This is not about baseless paranoia or popular conspiracy theories, but about a perfectly justified, cold calculation of economic interests that unfolds before our eyes over recent years. Cryptocurrency has become a serious problem for various governments, not because it is inherently dangerous for ordinary people who attempt to use it, but because it actively evades their absolute oversight and command. This control over total surveillance that they have implemented through international legislation tells us something profoundly important about where the entire global financial world is heading in the coming years. Let us start with fundamentals and bedrock principles. Money has always been a central instrument of state power and societal control. When a state successfully controls the money supply in an economy, it controls the economic breathing of its country, its development and direction. It calculates taxes, precisely tracks transactions, knows who transfers what, where, and when. Most importantly, at the apex of this pyramid of power, it can apply financial sanctions against anyone, from ordinary citizens to the largest corporations. Cryptocurrency was specifically invented as a serious answer to this all-pervasive control. Bitcoin and its numerous successors were conceived and created on the basis of a philosophical idea about financial autonomy and complete independence, about money that does not depend on any central authority or state apparatus. It was truly a revolutionary idea, founded on deep mathematics and modern cryptography, but it quickly encountered one very real problem. States do not like it when something in the economy does not depend on them. Throughout the entire 2010, governments around the world attempted to simply completely ban cryptocurrency, but it turned out to be impossible to prohibit something that exists on a distributed global network of computers. This led them to a different, much more sophisticated and cunning tactical strategy. Over recent years, leading regulatory bodies around the world have begun to systematically respond to this challenge posed by decentralized finance. The European Union developed and adopted a comprehensive regulatory framework known as MiCA, which effectively established new international standards for the entire sector of digital assets and cryptocurrencies. This is truly a carefully crafted regulatory base that accounts for the technical aspects of the crypto market and the deep requirements of the monetary system. The United States, after prolonged hesitation during the administrations of both Obama and Biden, also took an important step forward. Earlier this year, a law called the Genius Act was officially passed, which establishes strict requirements for stablecoin special cryptocurrencies pegged to the value of the American dollar. Each such stablecoin must have absolute reserve backing in real assets, regularly undergo monthly independent audits, and strictly comply with all international requirements for combating money laundering and terrorist financing. This is a genuine championship of control in its purest form. And more countries around the world are joining this global trend, understanding that private digital currencies anchored to state money can be far better controlled and monitored in detail than simply prohibited outright. What is interesting? The vast majority of financiers and analysts believe this is good news for the cryptocurrency sector. Regulation means official legitimacy. When government bodies begin writing specific rules instead of issuing outright bans, it means they have recognized this sector as something real and permanent. Large institutional investors have been waiting for exactly this moment of legalization for years. When the American SEC approved spot ETFs for Bitcoin and Ethereum in 2024, the doors to mainstream capital officially opened wide. This allowed ordinary people, pension funds, and massive institutions to invest in cryptocurrency through traditional channels. But there was something deeply troubling about this regulation. Something ominous that few people understand when looking at this through a broad macroeconomic lens. The true reason why states want to control cryptocurrency does not lie in protecting consumers, although officially they will say so. It is about securing the financial treasury and monetary sovereignty. It is about global tracking of money flows. It is about maintaining the hegemony of the American dollar in the global trading system and architecture of international settlement. When alternative currencies and decentralized payment systems began gaining strength in times of geopolitical fragmentation, this threatened the very structure of the global economy, built upon the dominance of the American currency and American financial institutions. What is happening in the United States, and globally regarding cryptocurrency regulation synchronizes perfectly with critical instability at the very foundation of the American financial system in the stock market, specifically in the S&P 500 index. This is no coincidence, but rather the result of deep macroeconomic contradictions accumulated over many years, particularly after massive pandemic spending and perpetual federal budget deficits. To truly understand this tight connection, one must examine how power uses regulation as an instrument of hybrid influence on markets precisely before critical moments of crashes. The S&P 500 at this moment finds itself in a state of extraordinary fragile equilibrium. The index trades at historically record-high valuations that by many fundamental measures even clearly exceed the peak of the dot-com bubble in the early 2000s, when the Nasdaq fell dramatically by 78% overall. But this time, all official voices say on official government channels that everything is absolutely different from the past, insist defenders and holders of large positions in these companies. This time, the valuation is justified and well-founded, they say with confidence, because these companies have actual and material current profits, unlike the Enrons and other speculative mass of the dot-com past. Yet when you dig much deeper into official figures and fundamental metrics, you discover something truly alarming and troubling. Large portions of this expected profit growth are based exclusively on pure and optimistic expectations regarding artificial intelligence that has yet to create any real and material commercial profits on a global scale. Extensive research from MIT Media Lab showed that 95% of artificial intelligence pilot projects in large corporations created no real economic benefits, despite massive spending of $40 billion on development and testing. This should raise serious questions in the minds of investors and commercial analysts. If a large portion of the S&P 500's capitalization, especially its most important and largest components, is built solely on companies with valuation multipliers of 50, 100, and sometimes even 500 times relative to their current or even optimistic expected profits, what logically happens when these optimistic and lavish expectations begin to disappoint? This is an acute question that legislators and central bankers worldwide listen to particularly carefully. They know the answer very well, because this is an iron historical pattern that inevitably repeats every generation in the history of capitalism. The state sees the development of the cryptocurrency sector and decentralized assets as a potentially massive and threatening outflow of capital from traditional stock and bond markets. When people rapidly lose confidence in the S&P 500 and traditional capital markets, their first natural instinct is to quickly execute a flight to alternative assets that they believe are significantly safer and less dependent on the system. Gold consistently rises as never before. Bitcoin trades at record levels around $111,000 per coin, with fluctuations, precious metals, surge, and this is absolutely no coincidence. This is a clear sign that investors are consistently living in genuine fear and uncertainty. They are preparing for something significant, understanding at the level of instinct. Regulation of cryptocurrency plays several critical roles simultaneously, though officially in the media it is presented only as consumer protection against fraud. First, it attempts to retain state control over a potential global massive outflow of capital. Second, it establishes significant barriers to entry that prevent mass migration of people from the traditional financial system to alternatives. When crypto, exchanges must obtain state licenses, comply with bureaucratic requirements and compliance standards, and money transfer providers must adhere to strict know your customer rules, this effectively transforms Bitcoin into another controlled product monitored by the state. Third, regulation serves as a strong signal to the financial market and major players about cryptocurrency remaining and being fully legalized. The Federal Reserve debt of the United States has exceeded 120% of GDP. To service this enormous debt, the state constantly issues new bonds to financial markets. This had previously been handled primarily by foreign central banks, especially China and other Asian states. But geopolitical tensions have changed this dynamic completely. When foreign investors begin withdrawing from American bonds, this will have a cascading effect on the entire American financial world. Bond yields will rise as higher rates are needed to attract foreign money to finance American government debt. Higher yields mean stocks become significantly less attractive compared to bonds, since investors can obtain safe returns without risk. This forces investors to reconsider their portfolios. When large numbers of people simultaneously arrive at the same idea to exit speculative stocks and move to safer assets, this becomes panic, then crisis, and ultimately crash. This has already begun happening. In early April 2025, when the president announced an expanded tariff program on imports, stock markets reacted with wild panic. In just 2 days, the S&P 500 lost nearly 10% of its value, the largest 2-day loss in index history. More than $6.6 trillion was removed from capital markets in mere hours. The VIX, the so-called fear index on Wall Street, jumped to 45, the highest levels since 2020. This was not the final crash, as it might be called, but a convincing preview of what the crash prepares. It showed everyone how unstable the entire system is at its core, even with minor disturbances. Thus, the regulation of cryptocurrency precedes the S&P 500 crash not simply as a sequence of events or ordinary calendar coincidence. This is an integrated, long-term strategy for managing major risk. The state prepares for a major market correction, knowing with high degrees of certainty that it will come. Through all its coordinated moves towards strengthening cryptocurrency regulation, it prepares the legal territory so that when the crash occurs in full force, capital movements remain under clear state control. This is a deliberate, foresighted decision that crashes on financial markets cannot be avoided under laws of economics and cyclicality, but can only be actively managed through maximum control of what is possible. Economic history tells us that every major market correction has clear harbingers marked by changes in the regulatory environment and legislative landscape. Before the 2008 crash, there was deregulation weakening in the financial sector. Before the dot-com crash, there was loosening of control over technology companies and somehow passionate divergence in valuations. Now we are living through a time of accelerated, active regulation of alternative assets and decentralized finance. This does not mean that regulation directly causes crashes, but it means that people who understand this know with great certainty that crashes are coming for them. They are preparing, they are regulating, they are controlling. The relationship between government regulation and market stability has become an intricate dance of power and economics. Consider the timeline of events. Throughout 2025, we witnessed unprecedented coordination among regulatory agencies across different jurisdictions. The SEC established its crypto task force under Hester Peirce, known for supporting clearer frameworks. Treasury Secretary Scott Bessent, confirmed by the Senate and known as a vocal proponent of blockchain technology, began shaping financial policy toward measured oversight of crypto. David Sachs, appointed as the White House's AI and crypto czar, started helping create legal frameworks that provide clarity to digital asset matters. These were not random appointments, but deliberate positions filled by individuals who understand both technology and financial markets. Meanwhile, the traditional financial establishment showed cracks. In April 2025, a single announcement about tariffs triggered the sharpest 2-day market decline in history. The psychological impact was profound. Investors realized that their sense of invulnerability was illusory. Trading volume in crypto jumped significantly on those days as nervous money sought alternative havens. This was the market testing itself, revealing its fragility, showing that sentiment can shift faster than any fundamental analysis suggests. The VIX reaching 45 meant options traders were pricing in extreme tail risk. This kind of market behavior does not happen in stable systems. It happens when underlying confidence erodes. What makes this moment particularly significant is the convergence of multiple destabilizing factors. The national debt situation is not merely a number on a spreadsheet. It represents structural constraints on policy flexibility. Every percentage point increase in interest rates means billions in additional annual debt service. This crowds out spending on productive investments. It increases refinancing risk. Should foreign governments or central banks decide to reduce their holdings of American treasuries, the entire edifice could face pressure. The Chinese, facing their own economic challenges, have been net sellers of dollars. Japan, traditionally a major buyer of American debt, has reduced purchases. These are not dramatic reversals yet, but directional changes that matter. Artificial intelligence hype has created valuations that defy historical precedent. Companies with no meaningful revenues command market capitalizations in the hundreds of billions. Others with profits in the low single-digit billions trade at multiples that assume decades of growth. This is not sustainable indefinitely. Eventually, reality must synchronize with expectations. When it does, valuations will compress. This is inevitable. The only question is timing and magnitude. Regulators understand this perfectly. They know that traditional mechanisms for absorbing such corrections, capital controls, trading halts, circuit breakers, may prove insufficient if panic spreads widely enough. This is where cryptocurrency enters as both risk and solution. Risk, because if masses of people try to exit traditional markets simultaneously and flow into crypto, the traditional system loses control and tax revenue. Solution, because a regulated crypto ecosystem allows authorities to see and potentially manage these flows. Stablecoins pegged to the dollar become electronic versions of cash, traceable, taxable, controllable. They serve the state's interests while appearing to serve innovation. The genius of this approach is that it preserves the appearance of free markets and choice, while maintaining ultimate regulatory control. Consider what happens in the worst-case scenario. Unemployment rises as recession deepens, wages stagnate or fall, consumer debt levels are historically high, mortgage delinquencies increase, credit card defaults accelerate, banks begin to tighten lending standards. Commercial real estate, overextended and over-leveraged from the zero interest rate era, starts defaulting on loans. Regional banks, holding significant portfolios of these troubled assets, face pressure. Credit markets seize up as counterparty risk becomes acute. What was merely a stock market decline becomes a full-fledged financial crisis. In such an environment, the state needs to maintain some mechanism for conducting commerce and collecting taxes. Cryptocurrency cannot be banned, it would simply go underground or move to other jurisdictions. So regulation becomes necessity, not mere preference. The infrastructure for such a system is already in place. Blockchain technology, for all its philosophical origins in libertarian ideals, is actually quite friendly to surveillance. Every transaction is permanently recorded on an immutable ledger. Bitcoin is often called anonymous, but is actually pseudonymous. With sufficient resources and will, transaction histories can be traced. All transactions on major exchanges require identity verification. Regulated stablecoin issuers must maintain reserves and pass audits. The system is, in practice, far more transparent than traditional banking, where shell companies and offshore entities can obscure flows. When this unfolds over coming years, interesting times await financial markets. The S&P 500 could potentially fall by amounts ranging from 20 to even 50% from its current levels, depending on how swift and severe this crash becomes. Cryptocurrency in this scenario will play the role of capital escape valve, an alternative store of value. Gold will similarly surge higher as people lose confidence in paper assets. And the state will be there in the background, regulating, tracking, controlling the flow of capital through digital systems. People who know the rules of the game and adapted in advance will make significant money. People who do not know and did not plan will lose theirs. But there remains another story worth hearing. A crash of the S&P 500, should it occur, will not be the end of the world or the economy. Markets always have expansion and contraction cycles. They fall and they rise again. This is natural capitalism dynamics, and the state will not be thrown by it. It will ride through this, as it has done many times before throughout history. People who have good reserves of capital and cash, who begin investing at the bottom of the market with cheap prices await, great profits in the future. Cryptocurrency, after regulation, can become a valuable and necessary part of a diversified portfolio if you understand its risks and potential. In the final analysis, the regulation of cryptocurrency that we see today is a step in a much older dance of power, money, control, and confidence. It is not about technology, it is about how people with power guarantee it remains with them. And the signals we see in the regulatory landscape are loud enough for those who listen carefully. The state prepares for a great shaking, and it has determined that the smallest risk lies not in preventing this, which is impossible anyway, but in managing its consequences with maximum control of what is possible. The story of money and power continues to evolve. Cryptocurrency represents a challenge to state monetary monopoly that cannot be ignored or simply repressed. Governments have wisely chosen instead to absorb and regulate it. This strategy serves multiple purposes simultaneously. It preserves the veneer of innovation and capitalism while maintaining fundamental control. It creates a mechanism for tracking and taxing transactions that would otherwise occur off the book. Most importantly, it provides a pressure relief valve for capital flows when traditional markets become unstable. We should expect that when S&P 500 corrections occur, they will be sharp and violent. Retail investors who panic will suffer. Institutions with access to information and nimble execution will profit. Cryptocurrency will likely spike during these periods as money seeks safety in perceived alternatives. Governments will point to this as evidence that regulation is necessary and will tighten it further. This creates a reinforcing cycle where each crisis becomes an excuse for more control. The endgame is not mysterious if we pay attention to the trajectory. Over the next several years, the financial system will likely migrate increasingly toward digital infrastructure. Central bank digital currencies will probably emerge in many countries despite current American resistance. Private stablecoins will coexist, but heavily regulated. Cash will gradually become less relevant for major transactions. Financial surveillance will become nearly total. Privacy will be redefined as a privilege granted by states for those deemed worthy, rather than a fundamental right. This is the future these regulatory moves are constructing. For the average person, the implications are significant. Diversification beyond stock markets becomes essential. Holding some allocation to physical gold, land, or other real assets provides insurance against monetary upheaval. Understanding how financial systems actually work, rather than relying on conventional wisdom, becomes advantageous. Building skills and income streams less dependent on traditional employment structures offers resilience. Most importantly, recognizing that crises are recurring features of capitalism, rather than aberrations allows for better preparation. The regulation of cryptocurrency and the instability of traditional markets are not separate phenomena. They are two manifestations of the same underlying reality, a global financial system reaching the limits of its current architecture. The state understands this and is acting accordingly. Those who recognize what is happening and position themselves intelligently will navigate whatever comes more successfully than those who do not. This is not prediction, but pattern recognition based on history and current fact. The future remains unwritten, but its broad outlines are becoming increasingly visible to anyone willing to examine them carefully.